What is an index fund? What are all its advantages? Why is it so good that even Warren Buffett recommends index fund for a regular normal investor? We will find that out in this episode. Hello everyone, I am Vijay Mohan and you are watching Investment Insights. How does an index fund work? To understand that, let's create an index. We are going to create an index with 20 different companies. The market cap of each company is shown in the market cap column. Hope you remember what market cap is. If not, check out the Stock Market Explained episode in this channel. It is the total market value of the company based on the share price and the number of shares. Let's say that company 1 has a market cap of 10, company 2, 9 and so on, with company 5, 6. The rest of the 15 companies have a market cap of 1. The total market cap of all these 20 companies is 59. If the total market cap is 59, what is company 1's percentage in there? 16.95%. This 16.95% is the weightage of company 1 in the index. The bigger the company, the higher its weightage in the index. We can see the weightage of each company is going down as its market cap goes down. So a 10% change in company 1 will have a bigger impact on the index than a 10% change in company 20. Let's say that company 1 goes up by 10%. So its market cap becomes 11. It increases the index by 1.69%. But if the company 20 goes up by 10%, its market cap will be 1.1. This will increase the index by only 0.17%. This is how the individual price movement of each company in the index moves the value of the index. This is an example of a market value weighted index because the index is created based on the market value weightage. In this example, we have 20 companies. An index can be created with any number of companies. Indian index Nifty 50 has the top 50 companies in India, with Reliance Industries taking the top spot with 10% weightage. US index S&P 500 has the top 500 US companies in the index. Apple and Microsoft take close to 7% weightage each. Nasdaq 100 has 100 non-financial companies with more focus on the technology sector. Microsoft is 13% and Apple is 12% in Nasdaq 100 index. We have many other indexes in the US as well. Russell 3000 with the largest 3000 companies in the index. It can be a good proxy for total US market exposure. Russell 2000 is another index with the smallest 2000 companies from Russell 3000 index. It can be a proxy for US small cap. So what is the purpose of all these indexes? It is a good proxy to measure the performance of the stock market. Nifty 50 is a good proxy indicator for the Indian stock market. That means it is the benchmark for the Indian stock market. Similarly, S&P 500 is a good proxy indicator for the US stock market. When someone says the stock market is not doing good, they mean these indexes. Now you know what a stock market index is. What is an index fund then? If a fund is created with exactly the same weightage as an index, it is an index fund. Say for example, UTI Nifty Index Fund is created with exactly the same companies with the same weightage as the Nifty 50 index. So if the Nifty 50 index goes up by 1%, the index fund created based off of this index will go up by 1% as well. Similarly, Vanguard Mutual Fund VFIAX is created based on the S&P 500 index. Not just a mutual fund, an index fund can be an ETF as well. Vanguard's ETF version of S&P 500 index is VOO. If you do not know the difference between an ETF and a mutual fund, check out the mutual fund versus ETF episode in this channel. I am including a good list of index ETFs available in the US as a Google Sheet. The link is in the description. Check it out if you are interested. So why should someone invest in an index fund? As I said earlier, index is the benchmark. All the active fund managers try to beat this benchmark. It is very rare for an active fund to beat the index consistently for more than 5 years. If the professional fund managers themselves have difficulty in beating the index, you can imagine the retail investors. Not easy. It is to your advantage to invest in the benchmark itself rather than trying to beat the benchmark. Another advantage is its simplicity. You do not need to do any complex research or analysis. Investing in an index fund is a no-brainer approach. You just keep buying for the long term as and when you have money in hand. That is all you need to do. If it is an actively managed fund, you need to monitor closely to make sure that the fund manager is doing a good job with the fund. It is even worse in an individual stock. You have to constantly monitor to make sure that the company is consistently delivering up to your expectations. But with an index fund, you just buy and forget about it. It is as simple as that. Another advantage is its diversification. There is no need for you to hunt for different companies from different sectors to diversify your portfolio. When you buy an index like Nifty 50 or S&P 500, it is already well diversified with all the market sectors. A good performing sector will automatically get more weightage in the index. No work is needed from you at all. Then fees. When compared to an actively managed fund, the fees in an index fund is negligible because an index fund is a passive fund which just follows an index blindly. Not much work for a fund manager to do any analysis or research, and so it is very cheap. Another advantage is you do not have to look for the next Apple or Nvidia. As a company grows and becomes successful, it automatically gets into an index and gains more weightage. You will automatically get exposed to a good, stable, growing company. The index fund also has the lowest risk among other equity investment options. So an index fund is not just hard to beat, but also has the lowest risk and fees. And that is why even Warren Buffett recommends index fund for everyone's equity exposure. Saying all that, you should still understand the risks involved in investing in an index fund. We will cover that in the next episode. Thanks for watching.